Hi, Kirk Mitchell with Candor Advisors. Hey, if you're involved in an M&A deal, if you're in the process leading up to it, or you're just around the space, you're going to hear the term EBITDA thrown around a lot. For many of you, knowing that the accounting definition is earnings before interest, taxes, depreciation, amortization doesn't really help in trying to get to why adjusted EBITDA or EBITDA ends up being the thing that determines, kind of a buyout price, right? A multiple of EBITDA is what most M&A deals are done at. So look, if you're a founder or advisor to founders, the easiest way to get to it, take the net income number and then start adding things back. So the first thing you add back is the interest paid on any debt on the business. That's primarily because most deals are done on a cash-free, debt-free basis. In other words, you get to keep the cash as long as you pay off the debts. So interest gets. Now, then you've got taxes, okay? So the entity might change when it's been bought. So the taxes are reflective of your ownership structure or how you treat it as an entity. So add back the taxes, right? Depreciation, all right? If you have equipment and you're depreciating it on an annual basis, add that back. That's not really necessarily the way the economics are going to transfer when the business is sold. And then amortization, right? So if there are expenses that are being amortized over time, not all borne in 1 year like a cash expense, those then get added back. So then you've got your EBITDA. Now to get to adjusted EBITDA, the other thing you do is add back the non-recurring items and or the owner economics. So the expenses of you running the business, like your company car, the part of your vacations you take that are really borne by the business, and anything that is an accommodation to the fact that you own the business, that when you've gone or when you're no longer the owner of the business will change. So they will no longer impact the business's economics, either expenses or for that matter, income. You add those back. There, you're at your adjusted EBITDA number, right? So you've added back the interest, taxes, depreciation, amortization, you've added back the owner economics, any non-recurring items, then you've got your adjusted EBITDA, and then you'll have some sense. If you know that deals are being done at 6 or 8 times adjusted EBITDA, you have a sense of what your valuation is. It's not the be-all, end-all, and it can get a little bit more complicated than that, but that essentially forms the basis for valuation of your business. So if we can help, or valuation questions in general, or how to choose an investment banker, which investment banker to choose, how to get to the right M&A attorney, whether you should use an ESOP or find an outside buyer, hit us up, candor-advisors.com. We're happy to help. Thanks. Have a fantastic week.